There's no one better to talk to about it than George Lee. Now, he is co-head of the Goldman Sachs Global Institute, where he focuses on all things AI. He's widely considered one of the top experts on AI on Wall Street. He joins me here now. George, it's great to have you.
Morgan, great to be with you.
I got to start with Oracle. Last I checked, those shares are up 20% right now. This astounding RPO number up 359% year over year, almost $500 billion now. How does it speak to what we're seeing in AI and, I guess, the shifting landscape in terms of leadership positions?
Well, it's certainly an extraordinary market event for a company of that scale, for sure. I think it just reflects this situation we find ourselves in, where the infrastructure boom is so profound, and yet we find ourselves in a moment of capacity constraint. There just aren't enough compute cycles to meet the demand for tokens in the world. And so Oracle's booming business, the booming business of all these hyperscalers, they're delivering these computational cycles. It's just a commentary on what we see in the kind of demand and consumption profile of intelligent tokens.
How long and how sustainable is the spillover effect when we talk about capacity constraint for the Oracles or the CoreWeaves or some of the others of the world that are taking on some of this capacity that the hyperscalers themselves can't handle right now?
Well, that's obviously the $1 trillion plus question. There's no doubt. And, I think it's a consequence of will this demand profile maintain the current trajectory, the steep trajectory that we're on? How quickly can we deliver these cycles? And what other constraints may come to bear? I'm sure we'll talk about energy, which is emerging as one of the principal constraints here. And I think it has a lot to do with whether and when we'll find product market fit for these AI technologies within enterprises and with consumer use cases. We've seen great early progress, but that has to be sustained and accelerated, I would argue, to meet the moment of all of this spend.
So let's talk about it, because you spent a lot of time focusing on it. You've written papers on it, but this intersection of power and AI, where are we at in terms of that cycle, that build out, what needs to happen to fulfill the energy piece of this more quickly?
Yeah, as I said, it's really emerging as a principal constraint for the ability to deliver the infrastructure that produces these intelligent tokens. And that's in many dimensions: generation, transmission, supply chain, human labor. Actually, we're running short of electricians that are capable of delivering this kind of power. And I think there are two principal things to remember here. One is, like, your father's cloud data center was architected for 5 nines of availability and very low latency, because all of us abandon our shopping cart in 0.6 seconds. Second important thing to remember is that we build power in this country for peak demand, those days where it's 100 degrees in New York or Houston or whatever. And thinking about those two foundational elements, we're arguing that there is a way to brook that temporal gap. I mean, this ultimately, we will produce enough power assets, we'll upgrade transmission so we can meet this moment. But right now, there's a bit of starvation. Our belief is that the ability to think differently about the availability of these AI data centers is going to be a big difference maker. There's a paper out of Duke that talks about the ability to curtail workloads. So in those moments when it's 100 degrees in Houston and that power is required, you can manage down the demands on your AI data center, operate at 3 nines of ability, slightly lower latency, and therefore take down those workloads and then harvest the electrons that happen during more of the slack period. Now, Duke argued that there's some 75 gigawatts of power that you might be able to harvest from this workload discrimination and demand response. We think this is a really interesting way to brook this divide. But make no mistake, there is going to be a long-dated, persistent investment cycle in power necessary to power this revolution.
So basically, the data centers themselves become smarter. And we know there's a whole startup ecosystem that's focused on this right now. So I am curious, because we had Ali Ghodsi from Databricks on the show yesterday, and he talked about the fact that maybe there's been, at least initially, overexcitement, overspending, overinvestment on the promise of AI, and that seems to be coming back down to earth. But simultaneously, what he's seeing right now is that there is more adoption, there is more realization, at least the beginning of realization of return on investment. What are you seeing from your key vantage point, especially as many of these companies are starting to come public?
Yeah, well, Ali's obviously a super informed and very balanced observer, so I take super seriously what he says. We have found product market fit in the coding space, engineering and coding, and we find that at Goldman Sachs. Our engineers are using these coding capabilities and agents to produce more code. We found product market fit in customer support. Mark Benioff talked at length about that in his most recent earnings call. I would argue we found it in the advertising space. And, I think it's going to be a steady, slow accumulation of use cases that consume these tokens in the enterprise. There's a great paper out of Princeton that exhorts us all to treat this as a normal technology. While it has its magical qualities, it's a technology where the diffusion will be slow. Enterprises will take time to find product market fit. We'll have to change our habits as workers. We'll have to shift our workloads and our workflows. All that's going to happen. It just may take a little bit longer than we would like.